Hello everyone, welcome back to my YouTube channel. Today we are going to build a home loan hazard model, which you can see on your screen. But before going into the code part, we will understand from the scratch and on a very granular level that if you might have heard of all these terms like hazard model, PD, so that you should be able to easily grasp this. And even if you are not from this background, let me try to break it in a simple manner so that anybody can understand. Okay, now if you might have heard of all these terms like IFRS 9, lifetime PD, survival analysis, and obviously the hazard model, which is the topic for the day, then sometimes some of you might have got confused. And for those who it's new, I think that's totally fine. But the people who might have heard all these terms, right, that is sometimes very confusing because we don't know that whether we should be making a probability of default model or whether we should be making a hazard model. What is the difference, especially on a junior level? So by the end of this video, you will be able to understand what is a hazard model, how bank use it, why they use it, how to create a home loan, which is home lending also we call it, basically how to create a home lending portfolio in SAS using a hazard model, and how to create a Cox hazard model. That is very important. How to generate survival probability, which is going to be again part of the today's session, and how these survival probability are used for IFRS 9 for calculating lifetime PD calculations. Now on that note, let's get started. So before I go into the code, again, there are a couple of quick concepts, or I should tell you, or maybe you can make a note of that. I would also say that if you have your copy pen, so probably try to make a note of these things, right? So first try to understand what is the business problem here. So because if you don't understand the business problem, then you cannot differentiate which model to apply. So before even writing one line of code, let's understand the problem. Imagine there are two home loans customer. Okay, there is a customer A and a customer B. So customer A has a 20% probability of default. Customer B also have a 20% probability of default. Now in a traditional logistic regression model, this stops here because you cannot tell who will default first. It tells us both the customer have the same PD, but a bank want to know that how and when, who will default first. When will they default? That is the actual question, right? So customer A may default after 8 months, customer B may default after 5 months, but these are completely different situations from a risk perspective for the bank. And that's exactly why hazard model come to the exist. So what is a hazard model now? What is the probability of default that a customer will default at a particular point in time, given that you have the survival until then? So till the time it's defaulting, until then you have a survival. That's why hazard models are commonly used. And why they are used? They are used inside IFRS 9 lifetime PD calculation, sometimes Basel risk models and stress testing. So all these cases where we use hazard model a lot, commonly used, right? Now, if you see on your screen, so basically this predict when a borrower is likely to default. The same thing I have pitched to all of you right now. Just see what are the most common variable which you would be using. These are the actual variable which are getting used. So loan amount obviously is there. Then you have LTV, loan to value. Okay. Then you have this variable. Some of you might not have heard FOIR and DTI. EMI to income ratio. What is your EMI? What is your income? Then your age, it's very important. Then your credit score, which is given by the data bureau to the bank. And then time, like when you defaulted basically, as per the month of book. Month on book means what? Like from how many months you were the customer for the bank. That's very important. I hope this makes sense, right? So these are pretty easy, right? Loan amount is the loan amount which you have taken as a loan. What is pending? Then loan to value. Like loan to value means your property. Let's say the property is your home. Against your property, what is the loan value? So that is calculation done. That's the value of this particular variable. Then in DTI, debt to income, we sometimes call it, and we call it EMI to income also. So I think EMI versus your income. Let's say your EMI is like 50,000 rupees, your income is like 2 lakh rupees. So that's ratio, right? Then age is self-explanatory. Then credit score is calculated by bureau. They give you the data. So bank purchase that, pay for the score to the bureau. That's very simple. Then event definitions. Now what are events? So anything, whether a customer is defaulting or not defaulting, both are considered as an event. So if the customer default value in that particular variable is 1, that's a general practice. If 1, then that is considered as a default customer. Okay. And if the value is 0, the customer is considered as a non-default customer. So you can read it also like home loan default occurs when the default value equal to 1. This is again calculated by the bank, and then default equal to 0. This means that loan remanaging, like performance during the observation period. So basically the person is able to pay the EMI and all. Okay. Now the model which we are going to use. The model is going to be Cox Proportional Hazard Model, and for that we use this particular procedure in SAS. So that's why just remember this. Then model form, like what is the equation we would be using? So we would be using this equation, HT, then H0 multiplied by T multiplied by exponential of B and X. Now what are all these terms? So the breakup is that H calculates the hazard rate. That is the end goal in the end of this whole SAS code. That is our end goal, that we need to calculate the hazard rate of each customer. Then this is the baseline hazard which will be set, and then the risk factors involved when the customer is in the books. So this is about the equation. Then why bank use that? That is all about the banking application. As I told you that IFRS 9, and then it's used for Basel, it's used for stress testing. So there are several other three, four things which are very important from that perspective. So these are the banking application, but you don't need to worry on this. Now, expected relationships. Now, what is the meaning of this? So this means that higher the loan to value ratio, higher default risk of the customer. Similarly, higher FOIR, that means higher default risk. So all these columns which I was telling you are associated with a certain type of indicator that whether the risk is higher, lower or moderate. Again, lower credit risk means higher default. Then higher loan amount, potential higher risk. Then higher age means generally lower risk, because higher age means that this income will be stable for the person. That's how the general practice. Now, these are the outputs which will be generated by the end of this whole code. These are the steps I have broken down. Now these steps we would be following somewhere one by one. Okay. Now before you try to understand the code, let's try to understand. I think we are clear with the problem statement. Now we understand why we are creating hazard model, because we want to know the date when the default will happen, because PD model, or the probability of default model you can say, is basically only responsible for telling whether customer will default or not. This will tell us the actual thing, that when the customer will default. Okay. Now this is SAS programming. So if you are totally new to SAS, maybe you can go back and watch my SAS playlist, so you will be able to understand this. Okay. Now let's create our simple home loan data set. So this first statement is data and the name of the data set. This is used to create a data set called home loan hazard, thinking of it as creating a simple Excel sheet inside SAS. It's a simple Excel sheet, blank one. Okay. Then what I'm doing, I am just defining the variable inside that. So input is used to define the variable, and these are the name of all the variables. Then after that, now we will define all the column that will be present in this data set as per the value. So we have already defined that. Now using the data lines, we are giving the value to each of these column. Now customer ID, for example, 1, then time is 12 months, then 1 is the default flag, then 28 is the age, then we have the credit score, then loan amount, then we have LTV value which is 88, then we have the FOIR which is 55. Now similarly you can understand for all these 20 observation. Now when you will create a hazard model in real life, you will create for maybe millions of observations, but I wanted to run this into the SAS session. That's why I kept only 20 observations. So this is a free SAS University edition. You can just Google free SAS University edition and you will be able to get this screen. Just log in with your credential and you will get this. Now you just simply understand that customer ID is the most important thing here. Why? Because it's the unique identifier of the each borrower. That's what we should understand. And again, time is very important. Time is one of the most important variable in a hazard model. It represents the number of month until default will occur. That's why it's very important. For example, time equal to 10 means, what does that mean? That the customer may default after 12 months. So these are the important things which you should remember. Okay. That's why I'm just telling you in the very starting of it so that you understand it. Once I will run the whole code, you will get the significance. So default means what? This is the event. As I told you, default 1 means defaulted. Default 0 means it has not defaulted yet. Okay. Similarly, age, borrower's age, credit score, I have already told you, loan amount, LTV value, I have told you, and then I have told you FOIR value also. So now simply I loaded the data. This will create a data set. Okay. The name of the data set already defined on top. Now this will create a data set, and step 2, I'm just trying to print the data. Before building any model, we should always inspect our data. So PROC print displays the data. Think it just like opening an Excel sheet and verifying that everything looks correct. And why it's important? Because the data itself is wrong. If the data itself is wrong, the model will be wrong. But you cannot do that in the million observations. So you need to do sometime random sampling. Sometime you need to check some certain values, because sometime you know, right, that which values you need to check using SAS. So always validate your input data first. Here you have like only 20 observations. That's why we can simply print this and we can check this. So let me try to run this. I just selected this and then click on this running person. So now this has created this table and you can see all the values are properly present here. Okay, simply. No challenge. Simply we created a data set and we printed this. Now, third step is summary statistics. What does that mean? Like we try to understand the portfolio. So PROC means equal to like the name of the data set. Before modeling, risk analysts always try to understand the portfolio. That's what we always try to do. This step, basically step number 3, calculate summary statistics. As I said, the question can be answered by this is what is the average borrower age, what is the average credit score, what is the average loan amount, what is the average LTV value. All these questions can be answered using this particular step. Okay. Now just try to understand with the example interpretation. If the average LTV value is like, let's say 75%, just assume. It means on average, the bank is financing 75% of property value. That I think you got this. If the average LTV is 75%, that means that the bank is financing 75% of the property value. If average FOIR is 40%, FOIR variable, okay, then borrowers are spending around 40% of their income on the debt obligation. So these value actually tells you that. So that's what we are trying to make in this particular step. And I think you can simply check that, because this is the syntax used by the PROC means. Okay. Now in variable, I'm putting all these value. So I have just explained the value to you. Now when I will run this piece of code, if I run this together, let's run this. So you can see. So you have got all the value like number of observation, mean value, standard deviation, minimum and maximum out of all of this. Now let's go back to the code. Just try to understand. I checked the summary statistics, created the data set. Now what I'm doing, this is something you should read by yourself also in terms of understanding the concept, because if I'm going to explain this is going to be too much for you. So build a Kaplan-Meier survival curve. Now we move into survival analysis. Here on step 4, you are doing the survival analysis. Like this is the PROC which is getting used here. So basically PROC live test data equal to the name of the data set and plots survival. This create a survival curve which will be telling you. So basically you can ask what is survival curve, right? It shows the percentage of customer who continue to remain non-default over period of time. That is the meaning of survival curve. When I say time equal to time multiplied by default, you can see here. Okay, this value, because here I just created the survival curve. This is the most important statement in this whole survival analysis step. Time represents the duration. Default represents the event, and the 0 inside the brackets tells SAS that default equal to 0. What does it mean? It means that the customer has not defaulted and it's therefore censored. Now what is censorship? Obviously you can ask that. So suppose a customer has not defaulted yet. Do we throw away that customer? No, obviously, right? Hazard model allow us to use both customer who defaulted, customer who have not defaulted. This is one of the biggest advantage of survival analysis. Now the output of this, what it will show you, you will see a survival curve. A month, 12 month, maybe 95 customer will survive. Okay. Your time period of 24 month, maybe 85% will survive. A time period of 36 months, maybe 75% will survive. So now that is a huge percentage in terms of survival and non-default customer. At this particular time, survival probability gradually declines. That's what it means. Okay. Now we can simply run this. And when we run this, you get all this. So you can see, as I said, and guys, you will be also able to get this code. Just download it from the description box so that you will be able to understand it. This is clear. Now on the step 4, now I am going to build the actual model. So here is a procedure which we spoke about. This is the main procedure. So PROC PHREG is SAS procedure for Cox Proportional Hazard Model. That's why it's very important, because and SAS is very friendly, right? SAS has prepared the procedure. You just need to use that. Now in the model, if you see, I'm putting so many value. Let me just scroll it a little bit. Now you can see model time multiplied by default 0 equal to all these variables. This tells SAS use these borrower characteristics to explain the timings to default. Now what is SAS learning here? That is something you should understand. It is trying to identify which variable increase or decrease default risk for the bank. Okay, obviously you will get that because bank need to calculate on the customer level itself. So now this is something easy. I think it's pretty much fine. Now expect banking relationship. Like these are certain things you should know. Higher credit score, lower default risk, and higher LTV, higher default risk, and higher FOIR, higher default risk. Old borrower, usually lower risk. So that's what it tells you. And let's try to run this piece of code. So you can see, just like you create a logistic regression, similarly you are creating all these value using this particular procedure. Now let's go back to the code. In the next step, what I'm trying to do, hazard ratio makes model result much easy to understand. So that's what I'm trying to achieve here. Like hazard ratio greater than 1. When I mention that, this means the risk increases. Now let's take an example. So for example, LTV hazard ratio equal to 1.05. Not this one, just try to understand. And as I said, try to make a notes of this. So if the LTV hazard ratio is 1.05, every 1% increase in LTV increase default hazard model by approximately 5%. Now hazard ratio less than 1, in that case risk is decreasing. So example, credit score ratio is 0.98. So every point increase in score reduce default hazard by approximately 2%. Okay, I think that makes sense. Now let's go a little bit down. All of that we have done in step number 6. So let's move to step number 7. This is validate model assumptions. What I'm trying to achieve here is basically test proportional hazard assumptions, check whether hazard ratio remains constant over a period of time. P-value, all of you should know. If you're not from statistic background, check my video on P-value. Then assumptions are generally satisfied. So every statistical model has assumptions. The Cox is a very important word. Just remember this. The Cox, not Crocs, it's Cox, okay, COX. So the Cox model assumes that the relationship between variable and risk remains reasonably stable over a period of time. If the assumption passes, we can trust our model more confidently. That's what the whole purpose is. So we are again using PROC here, and title is just to give the title in the output. That's nothing much there. And then you can see we are trying to assess that value. Okay. If the assumption passes, so we will be able to trust this. Now here we are doing that. We are checking that. In the next step, we are just doing a general survival probability. Now comes the most valuable output. Here you calculate the output, and the baseline is also set here in this step. So I'll come to that. This statement of baseline, if you see, this is something new for all of you. The code you have seen. This is a statement, create a brand new data set. The name would be mortgage survival. Okay. And what does this data set contains? It contains model generated survival probability, and the output will have the survival probabilities, month, and several other columns, obviously, which I am containing. So then let's try to run this, and then I will tell you the interpretation, how to interpret this. Now let's run the whole code. I'm now selecting it, just click on run. So go to the output data. This is home loan hazard. This is your input. Mortgage survival is your output. Now see this. So you have age, credit score, loan amount, LTV, FOIR, time, and survival probe. So at any month, at a month 36, for example, let me try to interpret. Okay, just try to understand it from this perspective. At any month, let's say the month is 36 on the third year. basically at the end of third year. So at month 36, 80% of borrowers are expected to survive. This remains only 20% are expected to default. So this is telling you after 3 years, only 20% will be expected to default. That's the simple interpretation on this step. And now I will just view the output because I have already ran the whole code. So as you can see, that particular step in the code, which is your proc print, has printed this, nothing else. So after that, you can also export this data, but this simply displays the survival probability generated by the model, this particular hazard model, simple. So final output at the end of the entire this whole process, what you are getting in this, our input data set contains borrower information. Okay, but at the end, this mortgage survival data set, this is our output data set containing survival probability generated by the model. Now there is a huge connection between this and IFRS 9. So just try to understand. Let me go to the output. Yeah. So now just try to understand. Let's connect this to real banking. Suppose at the 36 months, as I said, survival probability is 80%. Then lifetime PD we will calculate. Lifetime PD will have a formula. Lifetime PD equal to 1 minus survival probability. That is 20%. So output is 20%. So this model directly helps generate lifetime PD estimation required under IFRS 9. Okay. So on that note, I think I have made it clear for the people who already know a little bit about SAS and hazard model, because this is a very high level concepts. So the very senior people in the bank are working on this. It's not usually given to the junior resources. So that's the complete workflow of a home loan hazard model in SAS. We started with a raw mortgage data, explored the portfolio, performed survival analysis, built a Cox hazard model, generated hazard ratio, validated assumptions, and finally created survival probability that can be converted into lifetime PD. So now if you're planning for credit risk and IFRS 9, Basel model, or a risk modeling development interview, understand this workflow end to end. This will help you to build a strong foundation, because this is the exact business logic which is used in the real banking system. Now, this may be a little difficult for some people to grasp this much of knowledge, but if you have any question and if you want to break it down, you can let me know. I can help you do that. You put your comment and I can definitely reply to that. So this will help you. I tried to summarize this within 30 minutes because it's a huge topic. So I tried to kept it precise. Now, the important thing that you can download this code from my GitHub repository. Make sure you check in the description box. Now, on that note, if you like my content, please make sure you share this video with your friends, which gives me a reach, and you put the comment, which again gives me a good reach, and try to subscribe to my channel. Thank you so much. All the best.